what's going on, everybody? Hope that you guys all had a fantastic September. Wanted to jump on here for our monthly market update, give you some insights onto what's been going on within the portfolios, happening, macroeconomic data that's been coming out, and just overall how things have been performing. So I want to just continue looking at the narrative of the Magnificent Seven and tech stocks and what's been happening over the last 3 years. You guys have heard me say this a million times, but again, the Magnificent Seven of Tesla, Nvidia, Google, Meta, Alphabet, Facebook. I'm missing one more, but those 7 tech companies have been absolutely leading the charge for the market rallies that we've been seeing over the last 3 years, which is great. But it brings up the question constantly of why don't we have more tech exposure? Why don't we have more exposure just to US large cap growth stocks? Why in the world would we have any bond exposure or any small cap exposure or any emerging market exposure? Hunter, that stuff's been performing terrible. Why would we want to be diversified in that manner? I mean, I was even reading articles over the last few years. They've come up a lot of, is the 60-40 portfolio dead? The 60-40 portfolio meaning 60% equity in all different sectors of the market, 40% fixed income, meaning bonds. Again, looking back over the last 3 years, this is the total bond index here, down almost 4% over a 3-year period. I mean, that's terrible. For the conservative investor that had a large portion of their portfolio in bonds, they didn't perform well. Why? Because interest rates were going up. What happens when interest rates go up? Bond prices go down. So especially people that had longer duration bond funds during that rising interest rate period, they were getting torched. So again, then obviously as tech just continues to rally and rally and rally, everybody follows the masses and wants to have more Nvidia exposure or Microsoft exposure or whatever. And it's worked. I mean, obviously tech has performed great over the last 3 years. The NASDAQ, which is our tech heavy index, has been up almost 35%. So it's worked fantastic. Again, over this last 3-year period, S&P up 32%. As we know, S&P is the 500 biggest companies in leading industries in the U.S. economy. So that our U.S. large cap growth companies have been great. The Dow's up 24%. American Express here is our one individual stock position that we've been holding. It's up 66%. I mean, it's killed it. We haven't held it for the entire 3-year period. We've held it for a while, but it's been a great pick. It's done outstanding over this time frame. Then our other, I just talked about the bond fund down, 3.7% over a 3-year period. That doesn't get anybody excited. And then the other index that I wanted to talk about was the Russell 2000, which is US-based small cap companies. Another sector that has vastly underperformed over the last 3 years. And again, people would say, let's just take our small cap exposure and throw it all towards mega cap tech companies, right? Why not? That's what's been doing fantastic. Well, yeah, it has, but we can't bank on the Magnificent Seven to push the market forward forever. We're going to get to a point in time where there will be sector rotation. The market rally will broaden out and other sectors will perform well. And that's what we're starting to see. All of this, our diversified portfolios that we've been setting up for the rate cuts, it's starting to come to fruition, especially because we've gotten the cuts now, right? We've been talking about waiting for that was going to be our big tailwind when the Fed comes out and actually cuts rates, which they did last month in their September meeting. They cut rates by 50 basis points, 0.5%. I'll read you guys an article here in a minute. They're talking about probably continuing to do so, but they're in no rush. They're going to wait and see what the data says. So again, let's narrow in here to, since we've gotten the rate cuts, what's been happening over the last 3-month period. Again, this is a very narrow scope. You guys know I don't plan on investing money just for a 3-year period ever. We want to look out much further than that. But this is starting to show how the sector rotation is taking place, how people are moving away from solely being in tech positions, and how the rate cuts have affected the ability of other sectors to take off and perform well. So over the last 3 months, the NASDAQ, the tech heavy index, is actually barely up 0.5%. When is the last time that I did one of these where the NASDAQ was the lagging index out of all the ones I show? Probably never. I mean, I can't even remember the last time that happened. It's always been on top. So the S&P over the last 3 months is up about 4.5%. The total bond index is up 5.5%. And believe it or not, our long duration bond index or bond fund is actually up even more than that. Long duration bonds have been completely killing it. Because again, what happens when interest rates go down? Bond prices go up. long duration bonds go up more than short duration bonds do. So remember, I've told you guys we got into that position a long time ago, just getting ready for this, the rate cuts to happen. Now that they're taking place, our bond portions of the portfolio are doing absolutely great. Even the most conservative clients, you guys out there that have, 60% fixed income positions, your portfolios have been absolutely smoking it over the last 3 months. Then looking at the Russell 2000, so small cap companies, up 7.5% over the last 3 month period. That's a 7% difference between small cap and mega cap tech. Which again, we have not seen that spread in this manner. If anything, we've seen tech way outperforming small cap, but we have not seen small cap destroy tech like this in a long time. But again, now that rate cuts are happening, debt becomes cheaper. Small cap companies that rely heavier on debt to perform their business activities, they start to have an easier time doing so. So again, with all of these rate cuts that are happening, I just can't stress enough how much I believe that the diversified approach that we have been taking and we've been talking about, it's going to continue to work. And I just don't believe that the Magnificent Seven can push the market forward for forever. So again, and American Express up 16%. It's been such an outlier. It's really performed fantastic for all of our portfolios. So let's look up also really quick. I wanted to show you guys this article to drive the point home even more. So what I wanted to show during this article here for you guys was just the overall power that the Magnificent Seven has had, which has been great if you have the exposure. But again, it's also a little bit scary if you are overweight, too heavy in these companies. So the S&P 500 has strung together 37 record highs this year aboard an 18.1% rally. The advance has largely been powered by a handful of mega cap names tied to tech, the NVIDIA, Microsoft, Tesla, Apple, Amazon, Meta, and Tesla. So we've had, again, this is updated July 11th. This is old news. The numbers are a little bit different, but the story hasn't changed. It's still the exact same story. Up 18.1% as of July 11th. Without these 7 stocks, the S&P 493, without the Magnificent Seven, would only be up 8.3%. That's a 10% difference just by excluding the Magnificent Seven. It's insane. I mean, it just shows how powerful that those companies have been. So again, yes, if you caught it during the right time and you had that exposure while things are rising, that's fantastic. That's great news. But it worries me when that small portion of companies has that much power over an entire index. I don't like having that much risk out there within our investment account. That's why we diversify. That's why we have exposure to other sectors. And that's why we have not been going all in on tech stocks. So I know you guys get the point. Now, let's look a little bit more at the Fed and what we kind of see moving forward. Again, like I said, last month, I'm sure all of you guys are aware that they cut rates. It's a lagging effect. So we're not going to see money markets and high yield savings accounts drop right away. But probably over the next 3 months, we'll start to see some of those rates come down, which means that sitting in cash is going to be less attractive. People are going to be looking for better returns. So they'll probably start moving cash back into the stock market, and that could be another tailwind for the market moving forward. But Powell did indicate that if economic data remains consistent, there are likely 2 more rate cuts coming this year, but in smaller quarter percentage point increments. This is not a committee that feels like it's in a hurry to cut rates quickly. He said, if the economy performs as expected, that would mean 2 more rate cuts for a year this year for a total of 50 basis points more. So again, nothing crazy. I mean, they're going to wait to see what inflation numbers look like. If everything kind of remains constant, we'll probably get some more cuts, which means our bond funds will continue to skyrocket, I would believe. And these small cap companies in emerging markets, like we keep talking about, are going to have more and more firepower going forward. So all this to say, I know I can't stress it enough here, how important it is to be diversified, how patience will pay off while having good asset allocation in multiple different sectors. And I really think that we're in a great spot here moving forward. So if any of you guys have any questions at all, want to talk to me, I know I've been doing most of the portfolio reviews with all of you, but again, anytime, feel free, shoot me an email, give me a call. Always happy to chat about your individual situation. Hope that you guys have a great October, and I will be back in touch soon. Take care, guys. Bye.